Good day, ladies and gentlemen, and welcome to the Q2 FY23 earnings conference call of Shemaroo Entertainment Limited, hosted by Valorem Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anuj Sonpal, Chief Executive Officer at Valorem Advisors. Thank you, and over to you, Mr. Sonpal.
Thank you. Good afternoon, everyone, and a very warm welcome to you all. My name is Anuj Sonpal from Valorem Advisors. We represent the investor relations of Shemaroo Entertainment Limited. On behalf of the company, I'd like to thank you all for participating in the company's earnings call for the second quarter and first half of financial year 2023. Before we begin, let me mention a short cautionary statement. Some of the statements made in today's call may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audience are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Now let me introduce you to the management participating with us in today's earnings call and hand it over to them for opening remarks. We have with us Mr. Hiren Gada, Chief Executive Officer, and Mr. Amit Haria, Chief Financial Officer. Without any further delay, let me request Mr. Amit Haria to start with his opening remarks. Thank you, and over to you, sir.
Thanks, Anuj. Good afternoon, everyone, and thank you for joining us today for our earnings call for the second quarter of the first half of the financial year 2023. I hope everyone is keeping safe and well. Let me give you some key financial highlights for Q2 FY23. The operational income stood at 147 crores and has witnessed a robust growth of 53% on a QOQ basis and 19% on YOY basis. EBITDA for the quarter was 13 crores, a growth of 57% on QOQ basis and 26% growth on YOY basis. EBITDA margins stood at 8.75% and net profit was reported at 3.4 CR with PAT margins at 2.31% and an improvement of 205 basis points QOQ. For the first half of the financial year 2023, operational income stood at 243 crores, reporting a growth of 23% YOY. EBITDA stood at 21 crores and has witnessed a growth of 21% YOY. EBITDA margins for the first half stood at 8.64%. PAT was 3.9 crores, which has grown by 170% YOY. Speaking further on expenses on new initiatives for Q2, it amounted to 16 crores for the first half. While for the first half it amounted to 31 crores, and if you adjust for this investment in the new initiatives, the adjusted EBITDA from existing operations in Q2 and H1 FY23 would have been approximately 29 crores and 52 crores respectively. Let me take you through the traditional media and digital media division highlights. For the second quarter, digital media revenue stood at 64 crores, which were up 36% YOY, while for the first half of the year it stood at 112 crores, witnessing a growth of roughly 28%. Traditional media revenues in the second quarter stood at 83 crores, which were up by 9% YOY, while for the first half of the year it stood at 131 crores, witnessing a growth of 18%. Now I would like to hand over the call to Mr. Hiren Gada to brief you on the operational highlights for the quarter.
Thank you, Amit, and good afternoon, everyone. In the quarter gone by, the onset of the festive season witnessed a moderate increase in ad spends, but we believe that the ad spends will remain under pressure on account of concerns around inflation, looming global recession, and slowdown of funding for new age advertisers. Despite these uncertainties, we witnessed an increase in revenue, which can be largely attributed to the broadcasting and digital initiative. Happy to note that the contribution of our of B2C revenues in our total revenue has doubled in the first half of FY23 versus the same period last year. Though the company has delivered strong revenue growth during the quarter, we believe that there is also a bit of base impact of COVID-19 during the same quarter last year. In the broadcasting business, Shemaroo TV delivered higher ratings versus the previous quarter due to a renewed content strategy. In Shemaroo Umang, we launched our original production called Kismat Ki Lakiro Se during the quarter. We also started monetizing this channel through advertisements in the last quarter itself. Both Shemaroo TV and Shemaroo Umang have consistently been amongst the top 5 channels in the free-to-air GEC entertainment genre. In Marathi Bana, we adopted a change in programming strategy to include episodic content along with movies, which helped drive channel ratings during the quarter. On the digital front, we released 13 new titles in Shemaroo Me Gujarati during this quarter, with content across movies, web series and plays. We released an original web series called Vaat Vaatma Returns, which is a sequel to our last year's Vaat Vaatma, which was well received by the audience. We also did world digital premieres of 2 blockbuster movies, Nadi Dosh and Vikida no Vargodo, both Gujarati movies which have performed well. On YouTube, Shemaroo Filmi Gaane with 62 million subscribers continued to be the 20th most subscribed channel in the world. On other digital updates, we launched a free ad-supported streaming TV channel, which is called Fast channel on the Plex platform in USA. We also entered into a music licensing partnership with Resso in India. And lastly, we partnered with Seracle, a Web 3.0 technology company, to build Shemaroo's own NFT marketplace. In conclusion, we remain focused and confident on our long-term strategic growth plans, despite all the headwinds faced. Our diversified business strategy is beginning to bear fruits, although our investments continue. And we believe our growth and profitability trajectory will also continue. With that, I would like to open the floor for question and answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Shikha Mehta from Equity Capital. Please go ahead.
Good afternoon, sir. I have a couple of questions. First, could we get into details about your operating cash flows? At similar levels of PBT, almost a crore apart, we have reported an operating cash flow that was positive of 44 crore last March. This September, it's negative 12.8 crore. So if you could help me understand that better. And also our tax expense, because for FY22, our tax for the full year was 5 crore, but the tax expense in our September cash flow statement is 6 crore. So is this due to arrears, or could you help me understand that?
Yeah.
So with respect to tax expense mentioned in the cash flow, it is the TDS deducted. The tax expense per se is what is reported PNL.
Okay, so of this TDS deducted, we'll get the refund later. Could you just help me with your effective tax rate for the year?
It would be in the region of 26-27%. And with respect to the cash flow that you mentioned, the bulk of it has gone towards the increase in the receivables.
Right. So what is that due to, the bulk up in receivables?
The increase in the broadcast business.
Okay. So is this a one-time thing or is it expected to normalize?
It will kind of normalize going forward. This will be into a...
So as the broadcast business scales up, broadcast typically has a 90-day receivable practice, and as it scales up, it will definitely have some impact on the receivables. So it's in a way a reflection of when the turnover shrunk, that working capital got released because of shrinkage of receivables. But now that the top line is scaling up again, so with that scaling up, that certain receivables broadcast business receivables will be at a 90-day as per the industry norms.
All right. And so again on the tax front, last March, the tax outflow in the cash flow statement is 18.9 crore. So again, what is that attributable to? Because our PAT, like I said, was 5 crore.
Like I said, Shikha, both the tax amount mentioned in the cash flow is toward the tax deducted, whereas in the P&L is which is payable by the company.
Right. So for this TDS, we get the refund, right, later?
Yes.
Yeah.
Okay. And so if you could help me understand our ad rates better, have they moved up this quarter or what are we witnessing now? And out of our total inventory, how much commercial time are we selling and how much currently is being occupied by us?
So in terms of selling, as per the various norms, we are following as per the various norms in terms of how many minutes we can sell. So that is fully being sold. So there is a roughly 13 minutes as per the TRAI guidelines, TRAI or IMD, whichever is the relevant government body guidelines, and rest is commercial promo time. So that as per the guidelines we are following that. So that's the answer to your second question. What was your first question?
Oh, so sorry, 13 minutes per hour is...
Per hour.
Okay, and how much would be promo time?
I think roughly 2 minutes or so.
2 minutes. Okay. And so my first question was about ad rates, whether they've increased quarter on quarter and what trend we're seeing for Q3.
So ad rates follow essentially ratings, and since the ratings have been going up, the ad rates also have been going up.
So to understand this better, in order to increase our TRPs, do we have any strategy in play? Are we increasing our original content? You in your opening remarks, you spoke about the one TV show. Do we have anything else in the pipeline?
So at this point, between the two channels, we have 3 original shows running, which we've progressively been launching. So we have a crime show called Crime World, which is a 1-hour daily show, and with repeats, etc. And then there is another show which is the Hasya Kavi and Kavi Sammelan show, which is called Va Bhai Va, which is on Shemaroo. Both these are on Shemaroo TV. And on Shemaroo Umang, we have launched in September. We launched Kismat Ki Lakiron Se, which is Umang's first original. And yeah, we have many more shows in the pipeline, which we will be launching over the next few months.
And so what is the accounting policy for these shows? How do we write it off in the P&L?
We write off 80%
on the first telecast.
On the day of the telecast.
Okay.
Yeah.
Okay. Thank you so much. I'll come back in the queue.
Thank you.
Thank you. The next question is from the line of Dhwanil Desai from Total Capital. Please go ahead.
Hi, Bhai. Good afternoon. So the first question is, I think congratulations for good numbers. The first question is, so if I look at the operating cost as a percentage of revenue, that number has been fluctuating. So, last year's the same quarter, that was around 27%. Previous quarter, it was 36%. This quarter, it is 30%. So I assume that this fluctuation is majorly because of the content cost. So if you can clarify on that, and how should we look at this number, going forward? Is there a steady state range that we should be having in mind for this?
Yeah, so bulk of that cost is definitely on account of content. And going forward, as these businesses scale up, that trajectory should be coming downward because margin and operating leverage should be available. That's premise on which we are also operating and looking to scale the business, and that would be our effort to put it in that trajectory.
Right. Because the question I'm asking is because last quarter with 90 plus crore of revenue, this cost was around, our margin was around 36%. And this quarter it is around 30%. So what is the delta coming from? I mean, have we spent more on content? Why this number is going down? Because ideally, as you are saying, it should have gone up, right? Because the ad rates are better. We are monetizing Umang also. So why this number is coming down rather than going up?
So there are multiple factors. I mean, some of the cost also comes from some of the legacy costs on syndication. So that is also one of the things. But on an operating, as I said, directionally, this is where our attempt to bring it down is going to be.
Okay. Second question, sir. I think we had guided that this year we intend to invest around 50 crores in new initiatives, and most of that would be front ended. So the last second half would be having lower burn. So we are already spent around 30 crores. So do we assume much lower burn now rather than 15-16 crore a quarter in next quarter?
Yeah, I think that's what we are directionally very much on track for that. Both, I mean, 3 crore overall and higher front ended and lower back ended numbers.
Okay, great. And the last question, I think you alluded to this, that the receivable increases because of the broadcasting business and the reflation from base. But if I understand correctly, our syndication business had much higher receivable days, right? So compared to that, this should be a better business. Isn't that understanding correct?
Sorry,
in terms of working capital.
I got the background, but what was the final question that you asked?
No, so I'm saying that in terms of working capital, in terms of receivables and inventory required for broadcast business vis-a-vis syndication business, it is less working capital intensive compared to syndication business. Is that understanding correct?
Yeah. That is, in fact, that has been one of the key reasons also to get into this business, because the working capital nature of this business is significantly better than the trading business. Firstly, the whole inventory that we need, that itself comes off significantly, and second is the receivable days is restricted to 90 odd days.
Okay. And so last question, you mentioned that our B2C revenue has almost doubled. And if we look at our digital part, that also the growth has been pretty decent. So, if you can give us some sense as to what percentage of our traditional media revenue is coming from B2C, digital, how much is coming from B2C, some sense on that would be helpful.
Well, right now, unfortunately, I'm not in a position to give you that, but let me So, I mean, just to re-clarify what I said in the opening remarks is that the share of the B2C business in terms of revenue contribution has doubled. So, we're now on a good and clear path on the B2C business. So, sorry, but right now I'm not able to give you that granular detail at this point in time. But yeah, therefore, since we wanted to overall give a color of the fact that the B2C strategy is fairly on track, we kind of gave this, number or this indication actually.
Okay. So I have more. I'll come back in. Thank you.
Yeah.
Thank you. The next question is from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hi, good afternoon, and congratulations on the amazing set of numbers. So, my question is one regarding what do we see as our revenue going forward, because we've had a good bump in revenue. So, could you just share what our revenue growth are we looking at in this year and next year?
I mean, unfortunately, I'm not able to give forward-looking statement because anything that I say to this will be forward-looking. But what I want to differently, give you a sense is that, the underlying digital piece has typically been projected to grow in terms of the industry, the underlying industry. Depending on, if you look at various expert reports and all of that, or industry reports, they are talking of approximately 20% growth in the digital business for the next couple of years. And our effort always has been to, do better than that. And on the traditional front, on particularly the broadcast piece, at least we have been, it's a very low base to begin with compared to what is the overall industry size. So it's more a story of market share gain, or, I mean, not even market share at this point in time. It's just certain scale of the pie, which, share of the overall pie that we would aspire to take. So we are currently at least in a good position in terms of the setup and how we've grown these businesses and set these businesses up for a good trajectory.
Yeah, okay, thank you. That helps a lot. So another question would be regarding our new initiative. So if we remove that, our EBITDA margin increased significantly. So we've indicated the spend for this year, but could you give any sort of spend that you're expecting next year, or have the investments been, peaked in the current year? So going forward, what kind of an EBITDA margin? Previously, we've done above 25%, so that could come back as our initiatives come down and our revenue growth is coming in. So could
two things I would like to say. One is right now, so our next year's AOP isn't yet finalized. It's too early to do that. So it's very early for me to give any indication of what could be the investment amounts for next year. But having said that, on the margin front, I would say there are two things. One is, at this point, once say the TV business reaches its operational break-even point, the margin on that is still relatively lower, and over a period it will scale up on the margin front and get a better operating leverage. Now, how fast that will be is anyone's guess. We also are obviously trying to do that, but it will have its own growth trajectory kind of a thing. Secondly, in terms of, as far as investment is concerned, we would, as we've said in the past also, we would definitely look at expanding the network, adding some channels, etc., over a period of time. So that investment, thing will kind of continue, going forward till we see those opportunities to, add good, profitable propositions and grow the network to a respectable and healthy scale.
Okay, yeah, that helps a lot. So, if I can squeeze in one more question, I would just like to know what is the difference in our digital and traditional margins in general? So, what do we get that? Like, I'm assuming digital will be better than traditional. So, could you give
digital
some
margins have been better typically. The only thing over there is right now the investment in Shemaroo Me, which is, obviously, all of it going through the P&L. So that is pulling down the margins on the digital to that extent.
Okay, yeah, thank you. That answers my questions. All the best. Thank you.
Thank you. The next question is from the line of Shivam Saxena from ICICI Bank. Please go ahead.
Yeah, thanks for taking my question. Just two questions. One is, are you getting some deals from MX Player or Netflix to sell your content? And second is, why the debt has been increased? Or what is the reason for increase in debt in the last 6 months?
Sure. So, to answer your question, the first question, we are we are a large content partner to most of the players in the ecosystem, both the names that you have mentioned. I'm not able to specifically give details of any deal that we may have, but yeah, we work with virtually all the players in the ecosystem in terms of the syndicating some or the other of our library. And second question is on the debt side, right? So, so on debt, there's primarily, as I mentioned in the earlier answer also, is the whole receivables reflation part, which has in a way consumed our limits on the working capital side. So the drawdown has increased for the from our limits that we have. So if you see the receivables amount,
So utilization per se has increased on account of, so debt has not increased, but the utilization has increased. And also there is an investment towards the property and debt taken for the purchase of that property. These are the two primary reasons for the increase in the debt.
Yeah.
Okay. And are these contracts with the big players, they are fixed contracts or they are variable contracts depending on the viewership? How they are designed, basically, if you can throw some light.
As I said that I am not able to give you details of any specific. So see, fundamentally in our business there are three models on which syndication happens. One is a fixed fee model. On the other end is the purely revenue sharing model, and in between there would be a minimum guarantee and a revenue sharing model. So these are there would be different arrangements with each player. No single model available.
Okay. Thank you. Yeah.
Thank you. The next question is from the line of Nitin Sharma from MC Pro Research. Please go ahead.
Good afternoon. Congrats on a strong result. I have a couple of questions. First of all, would like to understand that it's a bookkeeping question, that interest cost going ahead for a full quarter, some idea on the quantum?
Okay. Interest cost for going quarter, we expect to be in the region of between 7.5 to 8 CR. based upon the increase in the overall interest rate scenario that has happened.
Understood. Thank you. So, what has gone well with the traditional media side? Are you seeing improvement in your overall ad rates? And like you said, then would like to understand that how much lag is typically there between you get aware of your ratings have improved and increase in the ad rates.
So typically there's normally a 45 to 60 day, as in roughly 6 to 8 week lag between increasing ratings and translation to revenue because of various factors, as in translation to better rates or rate revisions. It could be upward or downward, either way, depending on what is the ratings. So typically 6 to 8 weeks would be that this thing. To answer your question, what has gone well, I think, as I said earlier also to the earlier question, is that we came off from a low base of revenue and ratings on the broadcast business, and as the channel scaled up, and we have been reporting this every quarter about the ratings of say Shemaroo TV, etc., that have been trending upwards on quarter basis. So that is translating into the revenue of the broadcasting business.
Understood. And the last one, so can you please throw some light how Shemaroo Me Gujarati is doing, or if you cannot talk about it, then probably the Gujarati OTT space, and slash there's been some talk about your music device. Some color on that would be helpful. Thank you.
Sure. So, Shemaroo Me, as you rightly said, we are not able to give, direct details of. But if I have to, talk of, so the opportunity size that we looked at, Gujarati speaking population is roughly between 5 to 6% of India's population, and in a state where there aren't too many TV channels, and which has seen a revival in last about 5-6 years of the film industry in terms of urban films targeting youth and more affluent multiplex audiences, which has kind of paved the way for a good SWOT offering, and that's the need gap that we tried to fill. And we had, not only did we have a great starting point in terms of contentability, but a very good brand connect with the audiences, because we have been doing Gujarati DVDs, etc., from a long time. So I think that has helped us gain a very good mind share. So that is really the opportunity that we have targeted. The caution I would say is that overall in India, the OTT business is still at least a couple of years away from any significant scaling. So this is all preparing the groundwork for when actually it scales, and that is when the game really begins, and that's when the investment really starts paying off. But the important thing is that when that happens, are you present with all the great consumer insights, with the very good share of mind in terms of the brand connect, a very good subscriber base, all the technical integrations and aspects, etc. So there's a whole host of things that we have now put in place, which I'm very happy and confident that it puts a very good entry barrier into this market. The entire package of the offering, the share of mind, the technical the consumer base that we have put together, the insights that our team is gaining on a daily basis, the analytics that we are able to go through on a real-time basis. All of that put together puts us in a very preeminent position in the Gujarati space.
Understood. And on the music device side?
So, see, this hardware opportunity is something that we have been pursuing for some time. And in a different way, it was, trying to monetize the content through aggregated single-use device. This business got badly hit by COVID because it's a physical, so literally within 6 months of our launch, the COVID hit us. So, that business from there has, not really fully revived to what we would have liked it to. So, in that sense, we earlier had a devotional device. So, as a POC or as a, experiment, we thought that let's try and see if we can do a mainstream music device, and that's how we launched the Shemaroo Filmi Gaane speaker. It has just launched like a couple of weeks, 2 or 3 weeks before back, so it's very early days on the on any numbers and all. And as I said, if it shows good traction, we will scale it up. If not, then we'll kind of deal with it accordingly.
Super helpful. Thank you.
Yeah.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 on their touchtone phone. The next question is from the line of Forum Makim from Equity Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. I just had 2 questions. So, are any of our channels breaking even right now?
As I said earlier, I'm not able to give a specific channel level picture, but as we have shared earlier, we are well on track to be operationally breaking even in this second half of the year.
So what I wanted to understand is if our...
At an aggregate level.
Okay. So, sir, what I wanted to understand is if Q on Q our revenues have increased and operationally also we are doing better, then why is our new business expense higher in this quarter?
It is because of so couple of things I would say. One is because Shemaroo Umang started monetization only in July. So, still the revenue, etc., for that to pick up and reach certain steady state is, probably only now as we go forward, that will happen. So, to that extent, there is a certain investment on that. Secondly, even the new show that we launched, Kismat Ki Lakiron Se, etc., that also would have had some contribution to that. Third, on Shemaroo Me, that next level of scaling and taking the whole content and share of mind or marketing trajectory to the next level obviously needs a certain level of investment. So it's all in, taking each of these businesses in a way to one next level that the investment has kind of gone.
So we are maintaining the 50 crore guidance?
Yeah.
Okay. So my next question is, you indicated that in the traditional media, the broadcasting space has done well, but still we've grown only by 9% this quarter. So, is the syndication business, dragging the growth? Or so could you just give a breakup between the syndication and the broadcasting business?
Yeah, so there is a lag. There is a base effect on this in terms of last year's base did include a few syndication deals, which as I in fact said in my opening remarks that there is a base effect due to COVID. So that was last year when the wave 2 happened. We had some flurry of syndication sales happening at that time. So that helped us during the first half of last year, which in a way created a base effect for this year.
So could you provide a breakup between the syndication and the broadcasting business?
Unfortunately, right now I can't. What I can say is that the broadcast business is growth. I mean, the revenue in this first half has more than doubled on a year-on-year basis.
Okay, sir. So just my last question. Sir, in our cash flows, we have investment in properties of around 15 crores. So could you just throw some light on the same? Like, what is the purpose of this investment?
Yeah. So this is what Amit just referred to in the previous question on the debt increase, where we have an adjacent property to where we are located, which we were currently renting out. That property came up for sale, and we bought the property. As if the company bought the property, so that is the property addition.
Okay, sir. Thank you so much.
Thank you. You may press star and 1 to ask a question. The next question is from the line of Dhwanil Desai from Total Capital. Please go ahead.
Hi, then. Thanks for the opportunity again. So, can you give us some sense in terms of how ER has moved for all the 3 channels, YOY and QOQ? May not be absolute numbers, but at least percentage terms, so we get some sense as to what is the trajectory.
Umang is too new, so there is no trend that I can give on Umang. As I said, it's hardly been 4 months since the monetization of Umang has started. But to overall give a sense, and I would go back to the earnings trajectory, the ratings trajectory, because that is finally the linkage of the ER. And there I can say that broadly, Shemaroo TV has been roughly growing at 15 to 25, between 50, so approximately average of about 20% actually on a QOQ basis in terms of the ratings trajectory. So, with a lag, as I said earlier, with a 6 to 8 week lag, that would translate into the ER.
Okay. And so on YOY, that must be much higher, right?
Yeah.
Okay. And Marathi Bana?
Marathi Bana had earlier, if you recall, we had shared in the April call that post there was some rejigging on the free dish platform, due to which the ratings had dropped by more than 50% at that time, because the channel had changed, the transponder had changed, and the channel had, all the channels which changed, they all had dropped by anywhere between 40 to 80% in terms of viewership. So we had also come off by about 50-odd%. We've now regained back that and above, actually. Now we are above where we were pre this thing. So the ratings has now, I would say, stabilized for last about 2 to 3 months, and has been on a gradual upward trajectory, not some roaring upward trajectory, but gradual upward trajectory after regaining back. So that's really broadly been the Marathi Bana story.
Okay, got it. Thanks. That was very helpful. And secondly, on the digital side, this 35% growth if the substantial part of that is coming because of YouTube, or what is driving that growth? Because we used to grow at 20-25% number. So this delta of 10% is coming from which component?
So it's overall growth, but I would say that, yeah, Shemaroo has helped that definitely to an extent. But yeah, all have grown. It's not, I cannot, overall, if you recall and, get this thing, the overall digital space itself has been on a upward trajectory. So, therefore, all the components have been growing.
Okay. And just, to understand, I do understand and respect that you guys don't, give different kind of numbers for each of the components of businesses, but at least give us some sense in terms of margin trajectory or normalized margin for, let's say, a digital YouTube versus aggregation versus broadcasting, because as of now we are groping in dark because we generally get a one single number and we don't know how to look at that. So some sense, maybe a packing order, if not absolute numbers, that would be really helpful.
One of the challenges with that is that, there is a legacy, costing of some of the content in terms of the allocation of divisions. Now, while we also would like to do that, and we have been examining many ways to do it, the one challenge is that, the legacy costing of some of the content, or the allocation, I would say, of some of the content can make the margin structure very warped. So, there was a time when digital was just 10% of the top line, and therefore the allocation to digital may have been 10%, but today it's significantly higher, and naturally that cost, therefore the margin over there would, have gone up. These are some of the practical challenges. We'll still look into this. I'm not saying no to this. We have ourselves examined in last, in fact, seriously examined it in the last 2 months actually, in terms of what color or how we can give.
Yeah, I understand from where you're coming. So let me put it differently. So if I look at all other TV broadcasters, broadcasting networks, typically they make around 18 to, anywhere between 16 to 22% kind of EBITDA margin. That's the range that they operate in. So over a period of time, as we scale up, is that the right kind of aspirational number to have when we are operating on a steady state basis? Or do you think that there are some components which will turn it upwards or downwards in a different direction than this range?
So, I'll try and address it in a different way. So, aspirationally, yes, we would like to reach that kind of EBITDA margin, and I believe that would be a steady state margin that on an average most broadcasters, I doubt that anyone would make extraordinary margins over and above what would be industry benchmarks, right? But there are two issues within that. Is that most traditional broadcasters have a significant pay revenue. We, at this point at least, are in the free-to-air space, so there would be some difference because of that. Secondly, we have some our legacy Bollywood content, etc., which in a way has driven us significantly till now and will have its role in the way forward. So, we'll have to see how these two kind of combine to, give the overall picture. I would aspire for a better picture. So let's, hope that carries out.
Okay. But again, sorry, one follow-up on this, but what I understand, a lot of perpetual content would have been costed out, right, from P&L. So in a sense, it should work to your advantage, negating the pay revenue impact. Isn't that understanding correct?
Yes, for that. But as you see, one of the questions that you have also consistently asked is the overall inventory. So there is a charge off of the inventory also that will play out. And if you see, in fact, quarter on quarter, the overall inventory level has been coming off. We are probably at our lowest level in almost 3 years, or even more, I guess.
Okay.
So that of the charge off that is, and the consumption rather, that is happening, which is giving some of these revenue growths and all of that.
Okay. Okay. Thanks a lot. All the best.
Yeah. Thanks.
Thank you. The next question is from the line of Nitin Sharma from MC Pro Research. Please go ahead.
Thanks again. On the digital revenue side, in 1Q, YouTube share was around 60% plus and telco was less than 10%. How much you have changed in this quarter? And if you can please talk a bit about how ad-related payouts from YouTube in general are progressing. Have they slowed down?
So to answer your first question, broadly the contribution of the various streams have been similar, which is in fact why even to the previous question I had answered that the growth comes from almost all the categories, marginally plus or minus. So therefore the shares also continue to remain the same. The second question, if I understand correctly, you are asking whether YouTube payout has reduced. Is that the question, or?
Yes, that's right. Yes.
So payout is linked to their revenue. That there is no change in the payout policy, but yeah, have the revenues slowed down or reduced to an extent? Definitely, this global slowdown and the startup ecosystem, slow funding winter, etc. That is being so much talked about. That has definitely caused some slowing down of the YouTube revenue pie.
Understood. Thank you.
Yeah.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Hiren Gada from Shemaroo Entertainment Limited for closing comments.
Thank you everyone for joining the call today and spending your time with us, and I look forward to an exciting quarter, and happy Diwali to everyone in advance.
Thank you.
Thanks.
On behalf of Shemaroo Entertainment Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.